In this show, we're going to really dive into a topic that will always have a profound impact on how we lead our lives, both now and in the future. It's one of the topics that so many of you, our readers and viewers, have told us has caused you a lot of confusion and worry. That topic is our finances. The end of the year is really a time to reflect on the issues which touch San Diego and the rest of the nation. Our housing prices are in decline, our banking is in a state of confusion, and the stock market, as always, is so unpredictable. How do we make sense of it all? All these questions and many more will be examined by our next guest. In fact, a little more than a guest. We invited Steve Sexton to join us today to help us moderate the show and strike a dialogue with some of the top advisors in these subjects. Steve has an office here in San Diego, but his work as president of the Sexton Advisory Group takes him all over the country. Steve, thanks so much for coming on the show to be our expert moderator today.
Thank you very much.
It's great to have you. Now, you've been helping Southern Californians for over 10 years with their financial planning, and for the last couple of years, you've been on radio shows, TV shows, giving your expert advice. Now, you've helped thousands also in your workshops, your free workshops, as a featured speaker. Can you tell us what you see out there, your initial thoughts?
Well, right now, top economists are telling us, you know what, we're going to have 10 more years of what we've had. And on top of that, unemployment might not go down to 6% for another 5 years. We see what's happening in Europe, and the big thing that people don't realize in Europe is the Greece crisis isn't settled yet. And Italy is 3 times larger than Greece. Banks in the United States, because of their loans that they make to other banks, have a $50 billion exposure. And it's very, very tenuous out there. On top of that, we've got the Dalbar report that's just telling, hey, average investors are only getting about 2 to 3.6% return over the last 10 years. So it's a kind of a weird, dire situation that we haven't seen in many decades.
Now, you specialize in showing people the right financial path to be on and to avoid money essentially falling through the cracks. Now, what are some of the key elements to look out for when making decisions on investments?
Well, right now there's some big indicators that are going on. First of all, we see Europe, and there's many hedge funds managers, the people that manage billions of dollars are saying, hey, look, we have a crisis coming on, and I think people should take that as a sign, but there's other signs as well. For example, there's what's called the TED spread, and it's a 3-month treasury compared to a 3-month LIBOR. Now, the LIBOR is the rate that banks charge each other. When the spread gets larger, that means banks are getting more and more shaky about how they're going to be, if they're going to be lending money. Now, that tells investors, hey, look, you know what, equities might not be so good, and that spread has doubled since January. Next one is the spread between the 10-year treasury as well as the junk bonds. Now, on average, it's 6%. Just in the last few months, it's gone up 25%. Now, what that means is bonds have a higher default rate, and it's time to really look into those bonds that you have to make sure they're not going to be in trouble. The next thing is the credit default swaps. Now, all this is a contract, and they're paying a premium for it. It's like an insurance premium. Right now, it's 1.9%. Now, what that means is for every $190,000, it'll insure $10 million of these credit default swaps. But here's the big thing. That premium's doubled since January. And what that really means is if Europe goes into a full-blown crisis, they're very scared, and that premium's getting larger and larger. Now, one of the things on the home front here, many people had money in the market, say they had $300,000 in the market in 2006. Here we are, it's 2011. That $300,000 is now $200,000. And you know what? They say, you know what, I'm just going to stay in the market until I get back to even. The problem with that is, you know what, in 5 more years, it'll be 10 years that they will have that money out there, and it'll just get back to even. It looks really good moving forward, but the reality is you're moving backwards. And you know what? People need to think, you know what, hey, I need to make a change. How do I make a change? A lot of times they keep getting told that, don't worry, it'll come back. And they think for 5 seconds, like they might even be watching our show, and goes, you know, he's right, that's what I'm doing. But it goes out of their mind in 5 seconds. What they need to think about is, hey, you know what if I save $3,000 this year just on my taxes, another $3,000 from the fees I was paying because it lowered my returns. And if I positioned my money a little bit better, it would grow instead of go back. Now, if I visualize what I can do with that money, say that's $5,000 a year, I can go on a pretty cool cruise, and I can do that every single year that I make those changes. So right now is the time to sit down with your professional advisor, talk about the issues that are happening, make sure you're in the right market sectors, and make sure you're not paying too much fees, taxes, and expenses.
What else can people do? What would you advise on some other supplemental changes that they can make?
Supplemental changes they can make would be more like, hey, right now we're in the last 30 days of the year, so we need to focus on taxes. There's many things people can do right now, such as they have mutual funds. There's turnover costs in there that causes money to flow through with short-term capital gains, and it flows onto their tax return. They can sell off the losers to offset that turnover cost and not have to take an increase in their taxes. It saves them $2,000 or $3,000 a year. Like I said, that's a nice little trip or a vacation. In addition to that, people who own businesses, whether to take a bonus now or next year, makes a big difference. And in real estate, there's many things they can do.
A great way to kick off the show. Now, we'll be showing contact information throughout the show so you can reach out to Steve and our other professionals with questions. Steve's contact information is on the screen, and we'll show it again later in the show. Earlier, you were saying that it's actually the best time of year to start planning, especially when it pertains to taxes. Can you elaborate a little on that?
Oh,
please?
yeah. Just like I was saying, taxes are very, very important. Right now, people could have thousands of dollars just falling through the cracks because they don't make a change. See, on January 1st, it's too late for the year 2011. They're starting 2012. And if they don't do anything in the next 30 days, it could cost them thousands of dollars, like I said. Again, even people with portfolios, they have winners and losers. So if they sell off the losers to offset the winners in their equity portfolio, they can now have a higher basis, which allows them, if they need to get to the money, pay less taxes. And you know what? There's many passive investors in real estate. They know if they get too high of an income, it's going to take away, they're not going to be able to deduct everything. So it's more important to see what expenses they can pay now to get those larger deductions to pay less in taxes.
Right, and that's why you invited today to be with us on the show, one of the very few certified tax coaches in the country. CPA Daniel Green actually worked for the state of California as a business tax auditor and has audited over 300 businesses. Daniel, thank you for joining us.
It's my pleasure. Thank you.
It's great to have you.
All too often, many people just don't know how to utilize their CPA. And what I mean by that is right now is a crucial time for people to learn the questions to ask, or at least talk to their CPA about how they can adjust their taxes, because there's so much money that's just fallen through the cracks.
Yes.
And on top of that, many people, they take out investments, they may have done well or not done well, but they don't tell their CPA about it. What questions should people be asking their CPA right now?
Well, Steve, the main question to ask is, what can I do to save money on my taxes? It's not so much what questions you ask. Most people bring in that box of receipts to their CPA. All that allows them to do is record history. They put the right numbers on the right boxes. You need to tell your CPA and have your CPA ask you about your lifestyle. Where are you spending your money? What are your normal expenses? What are you doing that they can take from being non-taxable to being tax deductible? Basically making your life tax deductible. You need to talk about what's going on. What have you invested in? What items are happening in your life?
So what you're really saying is, if you talk to your CPA right, you can talk about writing history as opposed to recording it.
Exactly, Steve.
So with that in mind, what could we do in the last 30 days of the year?
Well, there's a number of things, Steve. One, if you're a business owner, it's a great time to fund or set up your SEP IRA. You can defer 25% of your income, up to $49,000, into a SEP IRA. Another item is if you have rental properties, whether it's commercial or residential, you can do a cost segregation, accelerate the depreciation, which lowers your income. That's another area. Another is if you've got appreciated capital gains. You've got items that have appreciated. There's zero capital gains on the 10 to 15% tax bracket. So if you've got family members at a lower income bracket than you're in, you can shift the income to them through your portfolio. They pay no taxes on it. So the family umbrella, if you will, pays less taxes.
So what you're saying there is, if I were to shift equities over to my daughter, who really doesn't pay any taxes at all, we can save a tremendous amount of money in capital gains.
Absolutely.
So right now, one of the things that we do for our clients is when we talk about equities, especially with capital gains, we want to take a look at that portfolio and we want to say, hey, look, every portfolio has losers. So let's get rid of those losers and offset those winners. We still have the same basis, but the amount that we pay taxes on is far less than what before. But that's the reason why people need to go to professionals, because they can save that money from falling through the cracks.
If you can save somebody $3,000, $4,000, $10,000, and that's year after year after year, absolutely. See your professional, whether it's a tax professional, a financial planner, whatever professional. Ask the questions.
That's great, Daniel.
Daniel, thank you so much for joining us on the show today. Now, if you have any specific questions about your taxes, Daniel's contact information is on the screen. The number is 951-587-3789, or you can go to egreencpa.com. Now, many people don't know this, but in San Diego, 84% of businesses have less than 20 employees. We are more involved with small and medium-sized businesses than we think. Our next guest is a specialist in businesses of all sizes. Joe Atchison's credentials are impressive indeed. Now, let's see. He's a CPA, has an MBA in finance, served as president and CEO in charge of reviving failing companies. The list goes on. Joe Atchison, thanks so much for joining us.
Thank you, Maya.
Joe, you're a certified business broker, a certified intermediary. You have over 7,000 buyers and sellers in your Southern California network. You know what's going on out there. Tell us about the trends, what's happening out there right now for businesses.
Well, I guess you'd say there's a new normal out there. Businesses that are based on discretionary earnings, like salons and spas, retail, high-end restaurants, they're not doing real well right now. I mean, if your earnings are down, you're a little worried about the economy, then you don't get a massage or a facial that month. And so retail, B2C kind of businesses, business to consumers, aren't doing well. Construction is really off because of the economy. On the plus side, businesses that are selling to other businesses, B2B, they're doing very well, especially if they're selling into strong industries. Other businesses that are doing well are businesses that relate to the aging population. I did a white paper a couple of months ago, Steve, and one of the facts in that white paper about the trends, the tax and demographic trends of the U.S. economy. And one of the facts in there is that every day from now through the next 19 years, 10,800 Americans turn 65. So if you have a business that's serving that industry, home health care, DME, durable medical equipment, anything having to do with medical, that's a real growth industry. So it's a real mix out there in terms of the industries.
So that's great to know, especially with the new market sectors moving forward. We're looking at healthcare. In fact, in my business, a lot of investments that house healthcare.
Yes.
Long-term care, assisted living, hospitals, doctor pavilions, they're doing very well and expected to do very well, very, very well for many years. Now, let's change courses a little bit. We have people that are looking to sell a business, but people got to buy it. So what are the issues with financing now that we've talked earlier in the show about banks that are getting a little leery about doing a lot of lending? So what's happening there?
Yeah, there's like 5 main sources of getting financing other than an all-cash deal, and about 4 out of 10 deals are all cash. There's a lot of people out there with a lot of cash, as you may know in your industry. The first one I'd mention is friends, families, and fools, they call it. Well, friends and family, they're not so eager to loan money to a family member given the uncertainty of the economy. Their net worth is down. So that's never been a strong sector, but it's been a helpful one. Home equity, real estate loans. 4 or 5 years ago, a good third of the businesses I sold, the buyers would pull $500,000 out, $200,000 out of their home and use that to buy a business. But as you know, about 4 years ago, most of that home equity evaporated, so that's not available. Another source is retirement funds. The federal government passed regulations about 15 years ago where you could take money out of your 401k and IRA, roll it over into an account and buy a business. No tax consequence, no early withdrawal penalty, no tax consequence at all. That's a good source still today. Most businesses today, 6 out of 10, sell with a seller note, where the seller helps finance that deal. And that's a growing piece of the business because of the problems in the other sectors. SBA, Small Business Administration, that's the only traditional place you can actually go to borrow money to buy a business. The SBA has tightened up. Banks are tough, including the SBA. In order for an SBA loan to be accomplished, the buyer has to qualify, and there's 4 or 5 factors that they have to meet, and the business has to qualify. And they've gotten a little tougher on those qualifications. The typical SBA deal today, I mean, technically they will loan 100% to the borrower, the buyer, to buy that business. But the typical SBA deal today is they'll loan 70%, the buyer puts up 20%, and the seller carries a 10% seller note.
Well, I want to go back to that point when you talked about seller financing. Many of my clients have found that the seller financing works out much better for them from a tax perspective, because as opposed to taking all the taxes in 1 year, they can spread it over to 5. In addition to that, they can arrange notes where they're getting interest only for 5 years, take an income from it, and then get a lump sum in 5 years or 7 years or 10 years. And it works out very well from a planning perspective to help them finance their retirement. All too often when somebody comes to me and they just pulled the plug and they're retiring tomorrow, they just put in their papers and they show up at my office and say, I'm retiring. There's not a lot I can help them plan with except for, hey, this is how we set the income up, how to reduce the taxes. But if I had somebody a year or 2 or maybe 3 or 4 years before they retire, boy, could I do a lot for them. I could show them the questions they need to ask, help them put them in the right position for the investments. You know, is that same type of thing work for your business as well?
I really like it when a business owner contacts me and says, I'm thinking about selling in 2 or 5 years, because I can get together with them, go through their business operations, give them the metrics, how that business is going to be valued and looked at by a buyer, and help them make some basic changes that will result in that business selling for a much higher price and selling faster than if they hadn't made some of those basic changes.
This is the reason why people need to talk to a professional just like yourself, because if they understand and learn the questions they need to ask, they could be making so much more money when they sell their business. In addition to that, they can stop a lot of money from falling through the cracks just because they don't know how to position themselves.
Joe, thanks so much for joining us on the show today. Now, for those of you who would really like to learn the questions to ask regarding owning, buying, or selling a business, Joe's contact information is on the screen. Now, Steve, one of the areas you've spoken about is the need for proper estate planning. What's your take?
Well, proper estate planning is unbelievably important. People need to understand how a will and trust work. Many people just think, hey, it avoids probate. But the reality, yeah, it does avoid probate, but it doesn't do anything for federal income tax. That's a bit different story. The other part is, if people learn the questions they need to ask when they're talking to an attorney, they can set up a trust that's in their best interest, in the best interest of their family, not only now, but in the future.
We have been very fortunate to have worked for the past several months with one of the premier estate planning firms in the country, based right here in San Diego. Our Michael Walters, or Mike to his many friends and clients, has given his expert legal advice on a number of broadcast venues. He is also a renowned speaker and has spoken to thousands at free workshops throughout California. We caught up with Mike at his office in Rancho Bernardo between speaking engagements, where he graciously shared with us the most common misconceptions when it comes to wills and trusts.
Thank you, Maya. It's always a pleasure to be on this show. I've been asked to talk today about common misconceptions about wills, trusts, estate planning, and so forth. It's really quite simple. There's only 3 possibilities. When you die, someone wants your stuff and someone needs your stuff. So how do they get that stuff? The first choice you have is to do nothing. If you do nothing, since dead people can't cite deeds, the court will have a special procedure. This proceeding is called probate. It takes about 2 years. During this period of time, your assets will be frozen, and at the end of the day, the state of California will decide who gets all your stuff. Now, the state of California has a set of rules. They're called the Rules of Intestate Succession. They're in the probate code. If I were to go through all those rules, I'd be here probably tomorrow at about this time, so I'm not going to do that. The second thing you could do is you could have a will. Now, when you have a will, it's still a court proceeding called probate. It still costs a lot of money and takes a lot of time, freezes the assets. But after that 2 years or so and spending a lot of money, you will decide who gets your stuff according to the terms of your will. Quite an improvement. The third possibility you have is a trust. With a trust, there is no court proceeding. Everything happens privately and secretly within your family. And you decide who gets all your stuff. As to the three possibilities, obviously, I think having a trust is the best. It saves thousands of dollars and a great deal of time, and it's much easier on your family. But let's get back to that, the court deciding who gets your stuff. Let me give you an example of what can happen with that. We had a lady come in to see me a few years ago, and she and her husband had owned a home for many years, and they'd had a hard time financially. A friend of theirs sent them to a guy, I think in Mission Valley, who specialized in difficult refis, and this was it, last stop. Next stop, bankruptcy. So they brought all her stuff in, and the guy looked him up on his computer, and he leaned back in his chair and smiled and said, "I got good news for you. So you're not a difficult refi at all. The problem you're having is that the wife has had a terrible business failure, just awful. That's what's pulling your FICO score down." He said, "Here's what I can do. Let's just have the wife sign a deed over to her husband. Put the house in the husband's name alone. Drop out of all the wife's problems, eliminate the wife from the situation, and I'll get you a great deal." So that's just what they did. The wife signed a quitclaim deed in favor of her husband, putting the house in his name alone, and it worked. They got a great deal. They got a new loan, they paid off their business debts, their credit card debts, their cars. I mean, they reduced their monthly payments by about 50%. Unfortunately, just a few weeks after that, the husband, while playing golf, just dropped dead of a cerebral hemorrhage. The house was in his name alone, and he had no will, so what happened? Well, the first thing that happened is he went through a probate. It cost about $30,000 and took 2 years. At the end of that 2 years, the house was distributed according to the rules of intestate succession. Who owns the house today? Well, the wife owns a third of the house, and her two sons, 8 and 10, own the other 2/3 of the house. Now, if the same couple had had a will, the husband had had a will, after a probate proceeding, the house would have gone to his wife. Still would have cost about 30 grand, but it would eventually go to his wife. If they'd had a trust, the house would have immediately gone to his wife with the stroke of a pen. Those are your three choices.
We'd like to thank Mike for taking the time out of his busy schedule to share with us.
Mike is one of the top trust attorneys in Southern California. And you know what? Many people, when it comes to trust, don't understand that there's a lot of misconceptions, misinformation, and unrealistic expectations, because they'll go to somebody like Mike, and as great as Mike is, they'll get a trust, and then, hey, they're 45. Their kids are grown up now, they're 65, and you know what? Everything's different. And where the things they're missing here is their life's changed. There's legislative changes. For example, there's a HIPAA form. In 2004, it changed. And when it changed, it says, you know what, if you're going to the emergency room in a hospital, they can no longer give you information unless you sign that HIPAA form. And the problem is, you don't have that form signed. So you need it as part of your trust as a general power of attorney over that health care. Secondly, many people, when they first get their trust, they might have a couple $100,000 in CDs. And then they put it into annuities. And then it grows up, and 20 years later we have a $500,000. And if they don't keep it updated and don't continue to have that conversation with their attorney as well as their financial planner and CPA, they could be setting themselves as well as their family up for a big time bomb of taxes. And what I mean by that is people have IRAs. They think it's covered under the federal estate tax. It isn't. It's interest income tax. And you know what? If they take all that money, buy the RV, buy the boat, buy the cars, the whole shot, hey, they could take out and spend $1 million, but you know what? The IRS is going to send them a 1099 for $1 million. And at minimum, there's almost $450,000 in taxes there. Now, that's a big example, but people do that with $100,000, $50,000. And you know what? All it really takes is to sit down with a CPA, your attorney, to make sure you don't have that money falling through the cracks and you're not burdening the ones that you love when you walk out on life with a big lump of taxes.
Steve, thanks so much for being our expert moderator on the show today. We couldn't have done it without you.
Well, thank you. You know what? It's so very, very important that people learn the questions they need to ask, but you don't learn those questions unless you're talking to a professional CPA, a financial advisor, and an attorney. It's so very important because if you learn those questions, you can start identifying ways to assure whatever decision you make is the right one for you. And remember, smart financial decisions do impact the quality of your life.
Now that's our show for this month. Thank you so much for watching, and don't forget to go to sdentertainer.com to view the feature segments of this show and find out how you can benefit by sharing San Diego's best with us. Remember, there are free movie tickets at stake. Until next time, I'm Maya Trabulsi. Have a great holiday season, and we'll see you next year.